High interest rates are causing debt burdens to rise across Canada. And yet, at the same time, we're also seeing home prices starting to surge. Inflation in the States did slow, though barely. And that is setting the stage for what might be a pretty tough battle over the next few months to get Canada sub 3%. So, what's a central bank to do? I mean, do you raise rates further to fight inflation and rising home prices and then slow the economy? Or do you lower them and help Canadians with rising debt and interest payments make their lives easier? We discuss all of this today on this episode, and we're going to also discuss a truly effective first time homebuyers incentive that was just launched in the UK and maybe coming to Canada in the near future. So, are these higher interest rates affecting you in some way? Well, if you're feeling the squeeze of these higher mortgage payments and want to know what your options are, feel free to reach out to us. Our contact info is below, and we're helping homeowners realize that there are options out there and probably some that you didn't even know exist. So we're here to help. And if you want to just have a chat, we're very easy to get a hold of. So let's talk about these debt burdens. First off, more metrics are in, more data is in, and we're here to share it with you. First one being mortgage delinquencies. Now, today they do remain at or very near record lows. We're talking about 0.16% nationally, 0.1.6. For reference, if we go back to 2010, 13 years ago, it was at 0.4%. And let's go back even further to 1996, where they reached 0.6%. That was a recent high. And again, that was almost 27 years ago. Now, the mortgage delinquency rate, sure, it is a bit of a lagging indicator because, of course, most banks don't call a homeowner delinquent until their payments are 6 months in arrears. So quite a ways behind. But let's also consider this. We're already 15 months into our rate hiking cycle. And yet these delinquency rates are still incredibly low at 0.16%. This is largely due to the fact that we still have a very strong labor market with basically record low unemployment. That has certainly helped keep people paying their mortgages. What's also fascinating about this is that you look to the two provinces with the highest property prices and therefore typically the highest mortgage amounts, Ontario and British Columbia, and both of those provinces are tied for the lowest delinquency rate at 0.1%. People in provinces like Alberta are actually having a higher rate. But again, 0.1%, 0.16% nationally is incredibly low. So let's also consider when you look at all the mortgages across the country here, it's about 1 in 5 that have actually felt that impact of these rising interest rates. But as more of these start to renew in the coming years, we can definitely expect these debt service ratios, the amount of our income that we have to use to pay our debts, to hit quite likely record highs by as soon as 2024. And what will that mean? Well, of course, less discretionary spending because people are going to pay their mortgage first. And if they only have that fixed amount of income to work with, well, they're going to pull back on some of the luxuries of life, maybe the dining out, maybe the vacations, and so forth. But even though that's a great metric, it's not all that pretty. So let's look a little bit deeper here, and Ryan's going to get into some of the other things that are happening when it comes to debt in Canada.
Yeah, I want to touch on the loss rates in credit cards, but even just before I do that, I just wanted to comment because I always find it so fascinating that places like Ontario and BC, where you have, arguably the highest levels of debt with the lowest levels of delinquency. And I think that's largely because those are probably the two biggest economies within Canada. So, when you do see a downturn, there's more places for you to go if you're an employee and something that happens to your company and your job, dries up. With a dynamic economy like BC, which has a ton of different industries, and same with Ontario, you're less likely, I think, to see higher levels of delinquencies in those more dynamic economies. So I just wanted, and as you get more into Canada, there's places in Canada that are, simply based around resource-based economies and things like that. And if that slows down, then, there's bigger problems there. But like we said, let's take a look at credit cards because this is a great leading indicator in terms of, whether or not people tend to default on their mortgages, right? So now things are ticking up a little quicker now. So to give some sort of perspective here, loss rates pre-COVID on credit cards were about 3.5%. And then when everybody got free money during COVID, that dropped dramatically and by more than half to 1.5% by January 2022. Since then, now it's back up to 3%, which is very interesting. However, no homeowners have been defaulting on their mortgages yet. Without first falling behind on their credit cards, right? So mortgages are typically always paid first, but the credit cards tend to give us some insight in terms of how consumers are spending their money and what they're spending their money on. The trend in credit cards leads to a trend in mortgage arrears, usually by about 6 months, right? So consumer insolvencies are rising too. We just saw the highest number of filings since March 2019. So basically, we're back at pre-COVID levels here. Consumer proposals. So what that is, i.e., that's your LOCs, that's your credit cards. They are at an all-time high dating back to 2007, right? So what all of this tends to show us is that there's significant stress, at least at the consumer level, that we're aware of that. Obviously, we've been reporting on that for some time, but it does indicate that the stress levels are rising and that cracks are starting to form. And I think that's why we started to see different rhetoric out of central banks. We'll get into that later.
Yeah, I just wanted to add a little bit of clarity too on the consumer proposals. That's essentially when people who have debt, they will go to a bank or a different financial institution and try to restructure those loans to make their payments more manageable. And those number of proposals are actually at an all-time high. So people have debt and they're starting to feel that burden. They're feeling the pain of those payments and they go to look for help, say, how do I actually make these payments feasible? How can I restructure this? And so that is definitely something to keep an eye on because it is, like Ryan said, it's a big indicator of some underlying financial stresses here.
Well, and to your point, Dan, I mean, a lot of the major banks in the States have also been doing that, right? Regional banks, the ones that have failed, this is what they do. They go and restructure their debt if they can. So it's happening at the consumer level and at the institutional level.
And yet somehow, even with all this increased debt burdens and these higher payments and this underlying stresses, overall consumer confidence is actually spiking. It's going up. It's on the rise, and it has been since around Q3 of 2022. Right now, that ratio is sitting at about 53%. It was as low as 43% on this cycle. And then let's pull back a bit and give you the big picture. So how does that relate to pre-COVID? 56%. Right before COVID, the consumer confidence level was at 56. Today we're at 53. It's almost back to where we were pre-COVID. The same thing is happening within the real estate confidence metric as well. It is on the way up. That chart is now registering 40%, but that is off of lows of 20% just back at the end of 2022. That's when prices were falling, rates were still going up. Definitely people were buying homes at a much lesser rate than the previous 2 years. And again, how does this relate to pre-COVID numbers? Well, today we're at 40%. Pre-COVID was 45. So confidence levels in both metrics are on the rise, and we're almost back to the world that it was back in January, February 2020.
Certainly, we're seeing that here in terms of the real estate market, but it's also evident in Toronto. I mean, check out some of these stats. So sales have jumped 27% in April. That's a month over month change. That's the largest rebounds since the COVID lows. This is at a time, guys, when listings are down 40% year over year too. So that's a ton of competition for a very few amount of homes. And the standing active inventory is down 21% year over year. This is the lowest in over a decade, right? So similar to the GVRD, the GTA inventory has been flat for all of 2023. Prices are doing something similar as well. They're up 2.4% just last month. That's a recovery number in my mind. GTA sales to list, that means what are the properties actually selling for versus their list price? They're at 104%. So typical property getting purchased at 4% over the asking price. Compounding the issue here is that dwellings that are under construction have actually declined for 3 months straight, including a 1.1% drop in March.
It's amazing because at least the 104% number is quite fascinating to me, because you look at Vancouver and we're still just sub. I think we're at 98.5%, meaning that the average list price and the average sale price, well, the list price is actually higher. People are getting it for under ask. Whereas Toronto, it looks like you're almost all but guaranteed to be paying over the list price if you're going in to buy a home. And it is 100% due to the tight inventory. Toronto, like the GTA, I think they're down to like 1.2 months of inventory right now. It's incredibly tight. And so understandably, people are fighting for what is available. Now, I want to talk a little bit further on credit tightening, because even with debt burdens and high interest rates, as we talked about on the top, and what Ryan just mentioned within Toronto, home prices are going up. We're 5.3% year to date here in Vancouver based on the HPI, and that will be going up again in May. So this could threaten, in essence, further credit tightening from OSFI and from the Bank of Canada, because they don't want to see home prices going up. And yet making existing debt burdens even more challenging for the people with their mortgages, with their credit cards, with their lines of credit, et cetera, if they were to actually rise. So as you can understand, Tiff Macklem at the Bank of Canada has a consistently hard job being pulled into very opposing directions here. So does he leave it where it is? Does he go up? Does he go down? We won't know until next month. But either way, it's a marketplace that I don't think he expected, right? We've got very strong unemployment. We've got houses ripping higher in the exact same interest rate environment that brought them down for 9 months. So fascinating landscape we're in again. Who's he going to make life easier for? Who's he going to make life harder for? Well, that might come down to the inflation print that we get next, and what just happened in the States, maybe an indicator of that.
Yeah, inflation in the States barely ticked down, right? It moved only a 0.1% month over month. So now we're down to 4.9%. Now that still did beat expectations. Expectations were 5%. So, I mean, it's a small win, but it's still a win. I think what we're starting to see too, Dan, is the more reports I read on this, the more we're starting to see economists that overall tend to believe that the easy part of cutting the inflation out has happened, right? This was the easy part. What's going to be really kind of hard now, especially moving ahead, is going from its current position down to 2%. That 2% is going to be a difficult target to hit, especially when you consider that the US added 236,000 new jobs. And a lot of those jobs in the service industry, right? So things like insurance, restaurants, education, medical care. And these wages are still surging because companies can't keep or retain their people. So they have to continue to pay them more and more to stay. That continues to add to inflation and pushes costs up, right? So the reason why you're paying more at the restaurant is because in order to keep the server there, they need to charge you more for the sandwich. So now to kind of go back to a bit more of a macro level here, interest rates have dramatically risen by 5 percentage points over the last year, right? And this is the highest it's been now in 16 years. So this also means this is the first time since the pandemic where interest rates are actually higher than the inflation rate. So I think what's going to be very interesting to happen, or what's going to happen over the course of time here, not in a short period of time or by a certain time, but over time, we are going to have the desired effect. Inflation will come down. It's just likely going to take a little bit longer. And in all honesty, I still think we're going to see a recession in the States at some time. I don't quite know how it's going to pan out here in Canada just yet, but a lot of what happens in the States is reflected here. So it's very possible we'll enter into a very slight recession. But again, there's a lot of variables, and I do not envy Tiff Macklem or Jerome Powell. I can tell you that.
Well, keep in mind the previous month in the States, inflation dropped a full percentage point. Mm-hmm. So to see that slow down to just a 0.1 in the following month is rather dramatic. And let's reference that to Canada, because they seem to work very similarly, right? They kind of, the inflation rates go down almost in concert here. And Canada, last month was 0.9%. It was very big compared to the States' full 1%. So are we going to see 0.1, 0.2 if, register for the month of April? Very likely, I think, here. But hey, we can also very much so be surprised. So that kind of wraps up where we are on inflation and debt burdens and what's going on. But I wanted to share another story, because when interest rates started going up and we saw people and their payments go up and stresses start to occur, we know that the government and the central banks do what they can to keep people in their homes. And the first thing they did, of course, was extend amortizations, which is one of the many levers they can pull. So there are people in their homes right now who came from having 25, 30-year amortizations who now have 40, 50, 60-year amortizations on their existing mortgages. They're still in their house. They're still making payments. It's not pretty, but it's prettier than the alternative. Now, let's also talk about other options of what could happen. And this is all in reference to what just happened in the UK, because the UK has finally created a way to help first-time homebuyers get into the market. We've mentioned before that in Vancouver, one of the most prohibitive things about our real estate market is the down payment. On average, there's a good number of people who can afford the monthly payments once they're in, but it's getting that 5, 10, 15, 20% or more down payment that makes things difficult, right? If your average home is 1.2 and you need 20% to get in that, you're looking at over $250,000, including closing costs, just to get into a home. That's prohibitive, of course. So the UK has come up with something that, well, it's not that they came up with it. They've resurfaced something they've had in the past. And interestingly, this used to exist in Canada as well. Around the mid 2000s, you used to be able to buy a home here in BC with 100% financing, zero down. You could even buy investment properties with 0% down back then. I missed that boat. Unfortunately, I bought my first investment property in 2012, and I definitely had to put 20 points down. Now, in the UK, for first-time home buyers, 100% mortgages are back. This is a new product, and it's got its stipulations. You have to be a first-time home buyer, and you have to currently be renting. And why are the banks doing this? Well, they can get obviously more clients out of it. And rates right now in the UK are about 5%. And to take advantage of this offering, the rates are 5.49%. So there is a premium to get it. But to me, this is one of the best incentives for first-time home buyers that can exist. This truly gets them into the marketplace. It's not, the little things that we offer here in BC, the first-time homebuyer credits and tax rebates and all this other stuff that almost nobody uses, because they're not truly incentivizing first-timers. Let's think of it like this. Zumper, which is it tracks rental rates here, as of May 2023, they've just reported that the average one-bedroom rent in Vancouver is $2,700. That's up 19% from just last year. If that same renter wanted to buy a home, well, right now, as of today, if you wanted a $100,000 mortgage, for every $100,000 of mortgage, you're looking at a payment of $533. If you wanted to go out, and if this incentive existed today and you're a renter and you're paying your $2,700 on average, and you want to go out and buy a $500,000 home with zero down and just start paying that mortgage out of the gate, your payments would be $2,665. Now, yes, of course, there are more expenses. There is your strata fees, most likely. You're going to have to pay insurance. You're going to have your property taxes. But even if that were to push up to, let's call it $3,100, $3,200 a month compared to your $2,700 a month, do you think there would be a portion of the marketplace that could find that extra $500 a month to become homeowners and immediately start paying down their principal and creating basically a forced savings account and live in their home and never get evicted and so forth? So cheers to the UK. I think this will really significantly help a lot of people get into that market, which, just like Vancouver, is insanely expensive. Mm-hmm. Ryan, what do you think of it?
Yeah, very interesting. I think, it's, I'm always a little weary of 100% mortgages because of how it was treated down in the States. So I think a lot of this is going to have to come down to how well the bank's oversight is in this situation, because banks can get really carried away. They could sell a mortgage to anyone in that respect. So, I think making sure the qualifying of the people where these mortgages are going to are actually going to get paid. But one of the biggest burdens to getting into homes across Canada, without a doubt, is the down payment. That has restricted so many people, or forced families who can only afford a one bedroom, and then you have 3 or 4 people in a one bedroom, and that just it just doesn't work, right? So they're forced to rent, and then they're forced to not participate in the equity or growth that takes place in the city, and we have a massive economic divide. So I think as long as there's good government oversight on the banks, or at least regulators that are looking at these loans, I think it's a great idea. Because it pushes people into the marketplace and allows them to actually rise out of their current economic situation and participate, like a lot of Vancouverites, would love to, I'm sure.
Yeah, I'm just running a quick number here. So remember last year, Canada's population grew by about 1.1 million. And in the first 2 months, the metrics for 2023 point that to almost double to 2 million. I don't think it'll hit that, but even let's say it goes to 1.5 million, population growth, largely driven by immigration, happens in 2023. Okay, that is 4,100 people every single day are coming into the country. And let's keep in mind, the average person who immigrates into Canada rents for the first 2 years. Obviously, that is going to drive the rental market up. And this is why, as of today, rental rates are at an all-time high, especially here in Vancouver. And I'm pretty sure Toronto is experiencing similar rental rates. So to help people get into properties and to maybe soften the pain of those rental rates, this is a program that could potentially work. I guess we'll wait and see for the UK. But if any powers that be happen to tune into our channel, hey, let's explore that. Is that something that BC or Canada as a whole could offer as well?
Yeah, I think we
that's
need
a great
solutions.
Yeah.
At the end of the day, we need solutions, right? So we don't have
we know what is currently in place isn't working. That's for sure.
Right. That's right.
Ultimately, it does create more interest and making it more accessible for people to get into being a homeowner. So there's a fight there too, and that gets pushed up. Ultimately, it's going to be supply, but hey, I thought this was a good talking point that we wanted to share today. So as always, thank you so much for tuning in, and we look forward to bringing you more information about having trouble today, about the Vancouver real estate market next Saturday morning as well. Have an awesome day.